Welcome back to my channel. I'm glad you're here. Today we are going to explore an important concept from our series Elements of Financial Accounting, which is known as capital or equity or owner's equity. So, ever wondered who really owns a business? Who really runs a business? Let's uncover the secret behind ownership, the power of equity. But sometimes the question comes in our mind, what is owner's equity? So the ideas come in our minds like owner's equity might be like somebody who is having a business or owns a business, somebody who has an investment in the business. So that might be the owner's equity. So today in this lecture, we are going to understand the owner's equity and its nature and what basically does it mean and how it is impacting the business. As I tell you that assets, liabilities, and equity, these three words are the ones that decide the future of any business, right? These three things are the main determinants of your business success or failure. So, as we have already learned about assets and liabilities in our previous lecture videos in the series of elements of financial accounting, so today we are going to uncover the you know things about owner's equity that will help you to understand further concepts in financial accounting. So, let's get started. The term equity, also known as owner's equity in the business or shareholders' equity, simply this word means ownership. Anybody who owns a business. Owns a business means investments made by the owners. They have no current and non-current classifications, just like we did read and understood and have memorized the classifications in liabilities and assets, but there are no classifications in equity. Rather, it has contributed capital and retained earnings, which I'll explain later on in the lecture. So, the definition of equity can also be like equity is owner's residual claim on assets after paying for liabilities. The term residual means leftover. So, why we call it leftover claim? Because we know that the business is a combination of investments made by the owner and also the amounts borrowed from the debtors. Because we cannot run the business 100% from our own income. If we even are capable, even if the businesses are capable of running the business 100% on their own, but they don't do so. This is for some reasons, because they have to make their business run smoothly, they have to make their financial statements, and they have to also enter the participation of the debtors, because it is going to cushion your business in some way. It is going to attract more investors for your business. So this is about balancing the accounting equation. So accounting equation, as we have known, that it is assets is equals to liabilities minus our liabilities plus owner's equity. So if we rearrange the equation, so it becomes owner's equity is equals to assets minus liabilities. Whenever we subtract the liabilities from our total assets of the business, suppose total assets of the business are 15 lakh, and if we deduct liabilities which are 5 lakh, what is left behind? It is 10 lakh. The 10 lakh is owner's investment in the business, and the 5 lakh were the liabilities. So this is as simple to understand about owner's equity. It's just the residual amount which is leftover amount after deducting for all of the obligations of the business, because debtors will not wait. They can sue the business, they can bankrupt your business, so we have to pay them first. In first place, whatever is left behind is yours, which is the owner's claim, or we can call it residual claim or equity. Let's understand what brings equity changes. Sometimes equity can increase, sometimes there can be decrease in equity. But what are the factors that brings the changes? So first let's see about increase. If the owner's equity can increase, it can increase by adding additional investments, by capital gains, which are the gains on your investments. Like, for example, the share price of your stock went up. So now the same stock, which was 100 rupee value worth in the market, has become now 150 rupee. So 50 is the capital gain. This is the additional value to the business. Equity can be increased by profits or investment called equity account or equity account. Okay, then decrease. The decrease in the equity happens because of the drawings, like owner withdraws amount from the business for his personal use, maybe. So the investment proportion will be declined, and the capital loss in the business, the reduction in the share price of the stock, maybe it was 100 rupee, now it has become 80 rupees per share in the market, because we know that shares are valued at the market price, not in at the book value. They fluctuate every day and many times in a day actually. So due to the loss in the value of share, you can have a capital loss, so the overall worth of the equity can decrease. Equity can be reduced by deducting losses or drawings. So if you deduct losses or if you deduct drawings, your equity account is always going to decline. So two situations of the changes in equity, either by increase or by decrease, and the factors I explained to you. Now let's see what are the equity components. The first component of equity, which makes up the equity section, is owner's capital or share capital, which is the investment made by the owner, the amount that he has contributed in the business. Now, it can be the sole proprietor, a one man show, a one man business. Maybe he has invested 2 lakh in the business, 5 lakh in the business. All his investment will be the owner's capital or share capital. Owner's capital. And in the corporation, for suppose there are like 100 shareholders in the market, and the capital is in amounts of millions, so each shareholder owns some thousands of shares. So that contri- contribution totally makes the whole share capital. The word share means that everybody has shared the investment, to build a pool of investment, that is called as a share capital. So another equity component is retained earnings. Very important, because each year when we are preparing a balance sheet, in every balance sheet we show the retained earnings section. We add the retained earnings in owner's equity, because retained earnings are all the earnings or the profits that you have earned from the that particular operating in that particular operating cycle. That is maybe the net income, right, that we show up in the owner's capital section, and we add that up in the owner's capital, which increases the worth of the value of the owner's equity. As I told you that it increases also. So when we add these retained earnings, which are the profits, our owner's capital increases, and in the years of loss we deduct the loss in the retained earnings section from the owner's capital. So the owner's capital deducted after the value becomes, less, so that is the decrease in the value of the owner's capital. So after the owner's capital we add retained earnings in it. There is the additional paid-in capital. I told you that when the worth of the share is increased in the market due to good performance, due to the quality materials of the business or the good name of the business, the value or the worth of the share has increased in the market. Suppose from 100 to 200 rupee, then the 100 rupee is the additional paid-in capital. That is a favor given to the business, and additional value added into the equity. So in place of 100 per share, now 200 per share is recorded. Drawings or dividends, this is also added into the equity owner's equity section. If we deduct the drawings, then also shown there. If there are no drawings, but if we have announced dividends, then that year in which we have announced the dividends are declared in the owner's equity section, from where we deduct it. Basically, we deduct the dividends, the proportion of the dividends from owner's capital account. To understand owner's equity in a better way, let's see the sole proprietorship business owner's equity statement. See the particulars and the amount. Owner's capital at start was 5 lakh as an investment. He added the income of the year which he earned in the operating cycle, which was 1 lakh and 50,000. After adding that, um, and we also deducted the owner's drawings, he did withdrawals which was 50,000. So owner's equity at the end of the year became 6 lakh. Now you see, this is a very simple and the basic example of the sole proprietor business, which is a one man show, one man business, no more shareholders at all the investment belongs to one person. Now let's see the example of a corporation where there are more than one stockholder. If you look at it, the share capital section, the common share capital is 1 million. So also company has issued the preferred share capital worth 5 lakh. So it's a choice of a company if they issue the preferred share or just one kind of share. But this has two kind of shares. One is the common share capital and the preferred share capital. So if we total them, it total becomes 1,000,005 lakh, the total worth of the equity. Now in that add retained earnings, you see that these retained earnings have come from the net profit of the last year, and it has been added to the equity section, and less dividends declared, because you know that dividends just are deducted from the equity because they are subtracted from the profits of the company, the owner's equity. The profits, after adding for the profits, you can deduct the dividends if you declare. So 1 lakh dividends are deducted. Total stockholders equity has become 1,007,000, as you can see. Now let me explain the additional terms that were used in our lecture, which is the retained earnings. Retained earnings simply are the profits that are retained in the company for its growth. As I told you, that net profit is the amount that we have earned or the income that we have generated from our successful operations in the business after deducting for the expenses that we did for generating the income. Net income is when we keep the net income aside, the proportion of a net income aside for um, future investments or some other projects, that is called the retained earnings. Just like we save some proportion from our budget in some side for any kind of future investments, it is usually mainly for the growth of the company or the expansion of the company's operations. Profits are kept, then distributing to the owners. Yes, because that's why we use the term retained, because we have kept them rather than distributing them to the owners in form of dividends. They are either distributed as profits or dividends if the company declares it, and they add value to the equity account by increasing the equity. The next term we used was the additional paid in capital. As I told you, but I am going to explain you in a much better way. Additional paid in capital is the increase in equity by increase in the value of the stocks. When our stocks value increases due to a good performance or a good quality or the good branding or the good image of the organization, then the value of the stock increases, because people start to trust the company, and they are starting to buy the products of the company is sharing more, giving more dividends to the investors. So this way, the demand of the shares increases, and this way the price of the share also increases as a demand and supply kind of concept. So equity increase actually is by the increase in the value of the stock. So the excess capital which we receive due to the sale of the stocks, or say at premium, is the additional paid in capital. You have heard the word premium, which means that additional, extra, to pay for something. So excess amount which anybody pays for a share or a stock becomes the additional paid in capital for a company of that stock. Additional paid-in capital can be applied to both common and preferred stock. It is that simple. So thank you for watching. I hope that this lecture was helpful to you. If any queries, you can ask me in comments, and I will see you in the next lecture. Take care. Allah Hafiz.